Those of you who have been following this channel for a while probably know that I do my best to present the topics to you in a, let's say, level-headed manner. I try not to get too swayed by emotions, sell everything now, run for the hills. I try not to do that because I don't think that's constructive. And at the end of the day, you're not really helping anybody to learn anything other than just kind of preaching at them. So today I want to just, if you'll indulge me, let me wear my tinfoil hat for a couple of minutes here. I want to share a story with you that I think has gone kind of under the radar over the last couple of days. And given what's been unfolding since Thursday with a couple of these regional banks and Jeffries and the auto bankruptcies a couple of weeks ago that we're now finding out had a lot more contagion in the system, and with other banks, you're going to start seeing this come out. So on the heels of that, I don't know if it was just before the news broke on Thursday or just after, but I see this today. Bloomberg, I think, released it. It's all over several media outlets. I saw it from investing.com. Goldman Sachs Group's chief credit strategist, Lotfi Karoui, Lotfi Karoui, Karoui, is leaving the bank after 18 years of service, according to Bloomberg, citing an internal memo. Karoui, sorry if I'm butchering that, who also headed, and here we go, credit, mortgages, and structured products research, was appointed the chief credit strategist position in 2017. Okay, so that's it's about 8 years ago he became the guy relative to credit strategist, okay, or for that role. And he was elevated just this last November to the status of partner at Goldman Sachs, okay? So he worked from 2017 until 2024, however many years that's at, 7 years to attain partner status. That became effective January 1st of this year, 2025, okay? And so now, on the heels of him being appointed partner, working 7 years at the firm, heading up their mortgage and their credit stuff, he, for unknown reason, departs Goldman Sachs, all right? And he was promoted to managing partner, all right, back in 2015. He began his career at Goldman Sachs in 2007 as an associate in credit strategy research and promoted to managing partner in 2015, managing partner, okay? And in 17, he becomes the head guy, and then just in the last few months, let's say 7 months, he becomes partner. Okay, so the guy spent his whole career at Goldman Sachs in this area. The same area, by the way, that's coming front and center with this new, let's say, banking crisis. And now, as pursued internal memo, he has left. So a little bit of research on Goldman Sachs. The management arm states have invested $215 plus billion in private credit globally as of March of this year via their private credit platform. They created a dedicated capital solutions group announced in January of this year, right? The same month that this individual, his partnership went into effect, to focus on origination and structuring of financing across investment-grade credit, leveraged loans, real estate, infrastructure, and mortgages and structured products. Okay? In mortgage markets specifically, Goldman offer a U.S. mortgage-backed securities portfolio fund, and they continue to be active as investors or asset managers in mortgage-backed securities. Don't forget, back in 2008, they were fined $5 billion and paid a $5 billion settlement in 2016 for connection to the residential mortgage-backed securities crisis. Okay, So let that sink in for a second, okay? And then chat says, if a major institution like Goldman suffers stresses in their credit/mortgage business, the ripple effects could be broad given their size. All right. So let me, I want to throw that out there for you today to think about before I jump into the next part of the topic. As I always humbly ask, please subscribe, guys, to the channel if you're not subscribed so we can keep growing the community. So, this is, again, just announced in the last couple of days. Not a real big thing. Obviously, we heard about the bank's earnings. Everything is doing great. But you have their chief credit strategist, after spending his entire career at Goldman, going back to 2007, decided to simply leave the firm. Now, in all fairness, we don't know if he was terminated, or if he resigned. I don't think that would affect my thoughts, my tinfoil hat side of me, right? That says something is up here. I'd like to get your thoughts, okay? And with that, I'm going to jump into just briefly. I saw out of Zero Hedge yesterday, we're starting to get dribbles of information about what actually happened with the bad loans, the bad collateral, Zion's Bank Corp and Western Alliance Bank Corp that came out just a few days ago. And there was an article yesterday out of Zero Hedge says the bizarre bankruptcy at the heart of this week's regional bank meltdown. Okay, and here's the point is the conclusion is, it says, in short, and you guys can go read the article for yourself, unprecedented chaos. Okay, it wasn't just a busted bankruptcy and potential fraud on behalf of a shady investor group. It was a bizarre, absolute priority rule waterfall, you-know-what show, in which, and listen to this, nobody knew whose claims were subordinated or priority. And the result was a free-for-all collateral grab, which was not, it says, quite rehypothecation, but very close. And the result was secured lenders, Zion's and Western Alliance, have now ended up chasing the assets, okay? Basically having, multi-million dollar loans out there for which the collateral is basically non-existent because it's illusory, okay? It's been hypothecated, assigned, transferred. So, I want to get your guys' thoughts and input on this. Do you think that it's coincidental that this guy from Goldman Sachs, who heads up their credit, mortgage, a major division at the bank, big player worldwide, especially in the U.S., do you think it's coincidental that right when this thing is starting to come out, that he leaves the firm? Or do you think it's just an isolated event and I am reading more into it than I should be? Again, we won't know until the next shoe drops, the next contagion is uncovered, and I think that's coming, or I think that is coming pretty quickly. Okay, so I'll close out today by sharing a personal story. Don't forget, I've been a real estate lawyer for 30 years now. I do a fair amount of transactional work, but I also do a lot of real estate fraud litigation, okay? And we often get, and I have a case right now where I represent a private lender who got involved in a construction project, lent some money to the developer, okay, was secured. Now, in this situation, my client took a second position interest behind an initial construction loan. But the construction loan was much smaller than the value of the dirt, and therefore he was secured. Okay, he was a junior position, and I didn't structure the deal. I never advised clients to accept a junior position as a lender for any purposes, too much risk. But at the time he made the loan, it was a reasonable transaction. What happened was the borrower, okay, who's the defendant in our lawsuit, prepared and had my client, who was not real good understanding and reading English, sign what's known as a subordination agreement. You heard that term subordination just now in the Zero Hedge article I read to you, okay, which is part of this you-know-what show. So when you sign a subordination agreement, you're agreeing to basically subordinate your collateral position to a senior lender or someone ahead of you in line. And this borrower, okay, who was the developer, went and took that subordination agreement and went and obtained a completely refied new construction loan. It was a 7-figure loan, not a 6-figure loan, that became the first position. What do you think happened? The loan defaulted, the developer didn't follow through, and the construction lender foreclosed the property. Okay, what did that do to my client's interest? It wiped out my client's position. A once secure position became worthless collateral, illusory. Okay, now he's suing for fraud. We're doing this for him and to chase the money that he lent in good faith. That's on a very, very small scale, guys, to what the Goldman Sachs and even Zions and the other regional banks are involved in right now. Okay, so I'm going to keep covering this topic. It's kind of in my wheelhouse. It's not good stuff. Okay, because the contagion again is going to impact the stock market. It's going to impact all of the types of investment markets as well, bonds, metals, cryptocurrencies, because when you start having real panic introduced back into these complacent markets, it's going to be that watershed moment, right? So I went a little bit long today. I appreciate you guys watching. If you enjoy the content, leave me a like, hit the subscribe button for me, share your thoughts and comments. And with that being said, I will talk to you all soon. Bye.